Hi there. In this part of our discussion, we're going to talk about adjusting entries. Now, what is adjusting entry and why do we need to do adjusting entries? The reason we need to do adjusting entries is because between the time that we were working until the end of the year, there are some transactions that are happening, but we didn't record them. So this is our opportunity to record those internal transactions. So it is a required part of the accrual accounting. Adjusting entries are part of accrual accounting. We can't survive without adjusting entries in an accrual accounting. Now, what is adjusting entry and how do we do them? There are 4 different groups. You don't need to worry too much about the grouping, but in general, there is the prepaid. The first part is the prepaid. Now, we have prepaid expenses. What does prepaid expense mean? If you remember, whenever we pay money for different assets, we kept them as an asset account. That is, basically, we paid ahead. And then now, it's time to record some of the expenses that happen because of passage of time, because of usage. What does that mean? Let's go to the T accounts and see some of the examples. We have supplies, for example. Supplies by its nature means the little things like the paper, the pen, paper towel, detergents, small items that we use every day. This marker is part of supplies. So we take out supplies, we use them, we buy them, and we use them every day. Now, it's very hard for a company to record every single time a piece of paper was taken out from the shelf. So what companies do is they wait until the end of the period, count what's left, and calculate the used part. The same thing for prepaid rent. What happened? We paid 1 year rent ahead of time. Now, after 1 month, 1 month's rent has expired because of passage of time. Equipment. We bought different items like chair, table, machines, cars. That is an equipment. We bought it, but the value after 1 month is not the same $24,000. So we have to have a way of recording expenses for all the uses that we did using these accounts. So to give you the first example, it is prepaid rent. Prepaid rent. Now, whenever we use prepaid expenses like supplies, equipment, or prepaid insurance, prepaid rent, the adjusting entry is usually debit and expense account and credit the asset account. So we reduce it from the asset and put it as an expense. For example, prepaid rent, what happened? We paid $6,000. If you look, go back and look at the transaction on December 1st, we paid $6,000 for 12 years, 12 months. Years, I wish. It's 12 months. So for 12 months, for a year, we paid ahead $6,000. That means if I divide this, it gives me $500 per month. So because I paid this on December 1st, because now we are on December 31st, after 1 month, this $500 should be taken out of the asset account, prepaid rent, and should be included as an expense. So the way we'll do it will be then the journal entry, it is going to be a December 31st journal entry. So in this case, the way we'll do it will be, as I said, debit and expense account and credit an asset account. Actually, I can use my journal, which is December 31st, and the debit is going to be, as I said, debit expense, credit asset. The debit account will be rent, expense, and the asset account I need to credit is going to be prepaid rent for just the $500. Now, I want to show you what that does to my balance here together. So prepaid rent was $6,000. whereas rent expense was 0. I didn't record any expense yet. So when I do that journal entry, what that does will be I credit the asset account, whereas I debit the expense account. So basically, I took out 500, which is 1 month's rent, for my prepaid rent asset account and record it as my expense. That will correct the balance of my prepaid and rent expense account. So I'll be left with 5,500, which is my adjusted balance. This is my adjusted balance, which is for the next 11 months. So that is the first adjusting entry that we prepare for the prepaid account. That's prepaid rent. By the way, prepaid insurance will be exactly the same way. You just divide it by how many months you paid it for, and then you take that 1 month's amount. If it is 1 month that passed, then you take it out of the prepaid insurance account and put it as your insurance expense. This is one example. This is our first adjusting entry. What's next? The next item I have is supplies. So for supplies, what happened was when we buy supplies, we debit the supplies account. Here's the same one, 2,300. 2,300 and supplies expense. But through time, once we buy it, we are using it. As I said, I use markers a lot, so I'm taking out from the shelf and using marker, but nobody's sitting down and journalizing supplies expense every time we pick one item. That would be too much work. So the way we'll handle it will be, for supplies, the information we need is unused, the unused amount or the remaining amount, what's left. So for this question, we have 1,300 as the remaining balance given. Now, what happened? If it is 1,300 that's left, rather than 2,300, my supplies account should show only 1,300. What does that mean? That means if supplies is 2,300, if I subtract the unused, which is 1,300, the remaining, the used, will be just 1,000. So I figured by using the unused from the balance, by subtracting, this is minus, by subtracting the unused from the total supplies, I figured how much we used. So the used one is 1,000. So what do? What I do is I'll take this amount out of my asset account and put it in my supplies account, just like the way it says. So I debit the supplies expense and credit supplies. So to journalize, I come here and say December 31st, debit supplies expense and credit supplies by the used. Remember, don't use the unused. That is what you want to keep in the supplies account. This is the used amount, and that's what I'm going to journalize here. So just to show you here, then if I put that in here, I'll have 1,000 and 1,000. That's the journal entry if I post it. Then what happened? I'm left with 1,300, which I actually have. Remember, this is the unused or the remaining from the information given to me. That's the remaining. So I was able to correct the balance of supplies by reducing supplies by the amount that we used and put it in my supplies expense account. That is about supplies. And the last prepaid amount we have is, this one is about depreciation. Now, depreciation by definition is cost allocation of long long-term assets. Now, we'll learn more detail about long-term asset, but for this question, we're given $400 as depreciation for December. So specifically, that's the information given to us. If $400 is given as depreciation for us, basically, how do we record this transaction? For this one, it's a little bit different, so I want you to pay attention to it. Even though we are going to credit the account, it's not the exact same account. So here's our journal entry. The same December 31st, we're trying to finalize, so we are doing all these things at the end of the period. So for December 31st, we use these two accounts, depreciation expense and accumulated depreciation for $400. Now, for depreciation, we always use these two accounts. We don't credit directly the asset account equipment. That is just a convention, because the logic is for long-term assets, crediting the long-term asset means we actually took the whole, physically the asset is going to be there, and for control purpose. So we use a separate account called accumulated depreciation, but it is a minus from the equipment account. So it's going to have the same effect as crediting the asset account, but it is a separate account, and we call it contra asset account. So when I report, in my balance sheet, I do equipment, 24,000, and I say less accumulated depreciation, 400, which will give me 23,600 net long-term asset or net equipment. So the effect is going to be the same, except we use a separate account. So this is all about prepaid expenses, how to adjust prepaid expense. Remember, it's the same way for prepaid rent, prepaid insurance, supplies, and a bit different, but same logic for long-term assets too. And in our next discussion, we'll talk about the other remaining accounts, and I'll see you next time. Okay, on this side, we have the second category, which is deferred revenue. Deferred revenue is when we receive money from our customers in advance without giving them the service. Sometimes customers pay in advance. How do we handle that? If you remember in our analyzing transaction discussion, whenever we receive money without giving the service, we have to put it as a liability. That is the deferred revenue account that we used. So if you remember, we received $600 for 12 lessons in advance. And if you go back and check the T accounts, we have $600 in our T account for deferred revenue. That is advance payment that we received. Now, at the end, when we look at our record, it shows that we had given four of the lessons. Out of the 12, we gave 4 lessons. So what does that mean? That means out of the $600 that we receive in advance, some of the service was provided. So we can take that out. Here, we're going to debit a liability account, in this case, the deferred revenue, and we're going to credit the service revenue account because we earned the revenue. So what we're going to do will be 4 times $50, which is per lesson, is going to give me $200. So that means we earned this. We earned it. So if I earned it, it's no more my liability. It is my revenue. So what I can do is I can do for deferred revenue, it used to be $600, And our service revenue, we have other transactions in here, but at this point, what I'm trying to do is I'm trying to take out $200 of the $600 out of my liability account and put it in my service revenue account. So how do I do that? This is going to be the journal entry. December 31st. Again, everything is going to happen on December 1st. That's our closing date. So on this one, what I'll do will be I debit the liability account, which is called the deferred revenue. So debit deferred revenue. And then I credit service revenue. I increase my service revenue because I earned the money by giving the service for $200 and $200. So if I post this, what happens is 200 will be posted here and 200 additional amount will be, so this becomes my revenue. Right now I'm gonna owe only $400, which is the remaining eight lessons. But I earned the one that I gave lesson for, and this is the deferred revenue. Deferred revenue, please don't be confused because there is this revenue word in it. It is definitely a liability. So it is going to be reported in the balance sheet as a liability. It is not a revenue. It doesn't belong with in the income statement, except the amount that we earn, which we'll take out from the liability and put it as a service revenue. And this is all for deferred revenue, and we'll talk about the remaining accounts and their treatment in our next discussion. Okay, now we're going to talk about accrued expenses. Accrued expenses are usually expenses that we incurred but not paid. How can that happen? Sometimes the payment time may not be there yet, but since we already incurred them, we should report them as our expense. A good example is salaries. What can happen for salaries? For salaries, in our transaction, in the 10 transaction, if you go back and check, we paid, the last payday was on December 28th. Then December 28th, we paid until December 28th for 28 days, probably $100 a day. That is $2,800 that we journalize as our salaries expense in cash. But now, after that, employees were working for the business. So 29, 30, 31, 3 days. Every day, $100, that will come up with $300 balance. So this amount, we owe our employees this $300. Do we pay them on December 31st? No, because we usually pay every week or every 2 weeks. We wait until the next pay date. But for our reporting on December 31st, we have to include this as our expense. But how do we do the journal entry? We always debit the expense account and credit the liability account because we owe them. That's what we are trying to show as a balance. So in this case, what do? The journal entry for salaries is going to be, again, it's going to be the same December 31st. I debit salaries expense, and then I credit salaries, pay attention to this, payable. If you remember in our earliest discussion, a payable account is a liability. So since I'm not paying on December 31st, I'm waiting until the next payday. But I want to show my expense because these employees earned their salary for those 3 days. So I debit salaries expense, that increases my expense account, and salaries payable, that shows I owe my employees for this amount. And the next example could be utilities. Utilities, maybe we received a bill, but we are not paying between now and December 31st or during this year. So utilities, for example, if we receive utilities bill for $900, we can't just keep that bill and pretend nothing happened, because this is our expense. So we want to include that during December when we report on December 31st. So we will do it the same way, debit and expense account, credit and liability, but this time, rather than salary, it's going to be utilities. So what I'll do will be December 31st, utilities, expense debit, and utilities payable, which is the liability account. Again, payable, except the named salaries here, it's utilities here for $900. Oh, I did write the 300 here. Okay, and one more thing is going to be interest. Interest expense, specifically. If you remember, we borrowed money on December 1st. December 1st, we borrowed $10,000 by signing a note from a bank. Let's say we owe, the interest is 12%. And between December 1st and December 31st, 1 month passed. So that is 1/12. So that is what happened. We borrowed money on December 1st, and as time passes, we incur interest expense. But we didn't get the chance to record that expense because we are not paying yet. We pay when the due date comes, but the expense should be included as our expense in the liability. So this amount is going to be, I believe it's going to be $100. So I record that as interest expense. Again, interest expense and interest payable. Again, the very similar situation here. So I debit interest expense and credit interest payable for $100 and $100. Okay, the last part of the adjusting entry, the fourth category, is called accrued revenue. Accrued revenue, just like accrued expense, it is the opposite. This time, we actually earned the revenue. We worked, we gave the service, but we didn't get the cash. So in that case, it is earned but not collected. For expenses, accrued expense is when we incurred the expense but didn't pay. On this one, it's the opposite. We earned the revenue, but we didn't collect the cash. So for example, in this one, we billed customers for service provider $700. In this case, what happened is we debit an asset account and we credit the revenue account because we earned the revenue, but we didn't get the chance to record it. So here, it's going to be December 31st again. The account I'm going to use will be accounts receivable, and then I credit service revenue for the $700 that we sent bill to our customers. So those are the four categories, as we said. The prepaid expenses is the first one, then deferred revenue is the second one, accrued expenses and accrued revenues. As I said, as such, don't stress yourself too much about the name of the category. What you need to know is what do we do for each items, and this will probably help you understand the adjusting entries. Adjusting entries are usually a bit confusing, so you probably need to watch the video or read the textbook a couple of times to really understand what's going on, but they are very important because at this point, as you can see the dates, it is one date at the end of the period. We sit down and update, as we said, used to update account balances. We need to correct, it's not an error we are correcting, but it is a matter of putting the right amount in the right account. So once we finish that, the next step is going to be to post these transactions, these adjusting entries to the T accounts And basically, we do the same thing. We post this to the T account, we calculate the balance one more time, and prepare the adjusted trial balance, because we adjust them by doing this. So if I post rent expense, prepaid rent, 500, for prepaid rent, 500 credit, and rent expense debit, 500. I use the red mark so that you will see the difference. Supplies expense, supplies credit, and the supplies expense account debit. Depreciation expense and accumulated depreciation expense 400, and accumulated depreciation 400. Deferred revenue and service revenue. Deferred revenue, we reduce it from the deferred revenue and we put it in our service revenue, because we provided the service for the amount we received in advance. Salaries expense and salaries payable. Salaries expense 300, and salaries payable 300. Credit for the payable, utilities expense and utilities payable 900, and utilities expense 900. Interest expense and interest payable credit, and interest expense 100 debit. The last one is accounts receivable and service revenue. Accounts receivable 700, and service revenue 700 will be we posted these accounts. Now, once I post, I will recalculate the balance the same way I did. Cash will never touch, any adjusting entry will never touch cash. If you end up having something that debit or credit cash for your adjusting entry, you probably need to look at the transaction very carefully, because cash will never be touched by an adjusting entry. For the rest of them, if I calculate the balance, now I have the adjusted balance, which is, in this case, 1,300, which is the remaining, if you remember, 5,500, again, the remaining. This one and this one will have only one balance in there. Service revenue, as you can see, is busy at 300, 1,200. I have 7,200. And then salaries expense is the other account with 2. That will be 3,100. The rest are going to be just their balance. Whatever they have only one line, we just take that as their ending balance. 200, 1,000, 400, 100, just to show that is balance after the adjustment. So we take that balance and prepare. This is the difference, so I put it on the bigger side, as we said, 10,000 here, 24, and 400. So once we do this, this is going to be our adjusted balance. Now we did the adjusting entry in the general journal. By the way, every journal entry goes to the general journal. So the same form is going to be used, whether it is an external transaction, the way we did from December 1st to December 30th, or the adjusting entry. Even next time, the closing entry goes to the general journal, just one format. You just go to the next line and do the journal entries. We post the adjusting entries. These red ones are our adjusting entries. Now the blue ones are our adjusted balance, the adjusted balance. So what do I do with the adjusted balance? I prepare the adjusted trial balance using those balance. And we'll say how to prepare the adjusted trial balance next time. And I'll see you next time.